to call upon stage Mr. Nitish Agarwal, Founder and Managing Director, Indium Capital. Ms. Mitali Chitre, Partner, Baring India. Mr. Anup N. Menon, Principal Investments, Chirate Ventures. Mr. Ashish Sharma, Managing Partner, Innoven Capital. Mr. Pallav Singh, Managing Partner, Spiti Capital. Let me introduce you to our moderator, Mr. Nitish Agarwal. Nitish Agarwal is a founder and managing director of Indium Capital, an investment bank focusing on fundraising and mergers and acquisition advisory and consulting services. Nitish has extensive experience advising clients on domestic and cross-border M&A as well as equity fundraising transactions across sectors. Prior to Indium, Nitish had leadership roles in Allegro Capital, GE Capital, and Genpact for over 18 years. He is a mechanical engineer from IIT and holds an MBA from IIM Calcutta. Over to you, Nitish.
All right, let's get started. Good afternoon, everyone. I guess it's the last panel of the day, and we were just discussing amongst ourselves just before this panel started that a lot of the discussions would be repeated probably, but we'd still like to get some different flavors and perspectives from what I would say is a fairly diverse mix of panels, panelists on the stage. So let's get right into it. I just request everybody, maybe you can start from the other side, Pallav, to just kind of talk a little bit about the fund and what you do, and then we can jump into the questions.
Yeah. So hi, hello everyone. We are part of a fund called Spiti Capital, or Spiti Cap in short. We just launched last year. It's an early stage seed to Series A fund with a corpus of about $350 million. We just did an initial close. We have about 10 deals. We are just getting in the market. So it's an honor to be here sharing the stage with all of you veterans. Yeah. So looking forward to be a part of the discussion.
How do I start this? Can you guys hear me? Okay. So I'm Ashish. I am the managing partner at Innoven Capital, and we are an Asia-based venture debt firm. So largely focused on India, China, and Southeast Asia. So we largely provide kind of structured debt. And we can also do small kind of equity checks as well within our portfolio companies. So, I mean, in India, we have a fairly large portfolio with, several hundred companies and, looking forward to do more as, the whole ecosystem deepens.
Hi, everyone. My name is Anup. I am a principal in the investment team at Chirate Ventures. We're a sector agnostic seed to Series B early stage investor. Been around for the last 16 years, have about 8 unicorns in our portfolio. And yeah, happy to be here and share some of our thoughts.
Hi everyone, I'm Mitali Chitre. I work with Baring Private Equity Partners India. We are one of the oldest private equity funds in the country, been investing here for the last over 26 years now. And spread across 5 funds, invested in over almost 95 companies in the country life to date. And we, again, are a sector agnostic fund. We are also stage agnostic, so we invest in early stage ventures. A bulk of our money does go for growth capital, but we do early stage, growth capital, late stage, and also invest in public equities from the same pool of capital. And, been doing this, like I said, for the last 2.5 decades, and we've delivered an IRR of almost 28% life to date.
Well, that's lovely. Thanks. Thanks, everyone. My name is Nitish Agarwal. I'm the Managing Director of Indium Capital. We are an investment banking advisory firm. We do mergers and acquisitions and fundraising transactions. Like I said, it's a very diverse group of panelists here. Pallav, early stage fund and a very, very young fund. On the other hand, you have Anup and Mitali with Chirate and Bearings, who are some of the oldest funds who are operating in India for a very, very long time. Though, Chirate and Bearings of, fund very, very different groups of companies. So that's a fair bit of diversity there. And then, of course, Ashish. Ashish does venture debt. The largest and earliest, one of the first people to start off the venture debt practice in India. It's a, carve out of what is now emerging as a private credit market in the country. So very, very diverse mix. So would love to hear some of the views. And let me actually start with Ashish, you, because as a venture debt investor, you actually co-invest with a lot of venture capital funds and you interact with a lot of them. In fact, we were chatting, you said you spend a third of your time meeting VC funds and possible investee companies. And your portfolio company. So you have probably a very good ringside view of what VCs are thinking, what the the portfolio companies are doing, what young founders who are looking to raise capital in this market are doing. What are your thoughts? We only talk about gloom, we only talk about negative words, but I always like to tell ourselves I'm a glass half full person that if 30% dip in venture capital funding means 70% is still happening. So what are the silver linings? What is still working? What are the things that you think need to be fixed? Let's start with you, Ashish.
I'm saying if I had to talk on gloom, then we can go a long way, but the silver lining should be quick, right? So, I mean, again, no jokes apart, I mean, clearly, this market is cyclical, as we know. There was just way too much capital that had come in during that 18-month period. And frankly, capital needs return. So ultimately that capital, the size of the prize in terms of the opportunity set or the, should have been large enough in a lot of cases with 2020 hindsight, though frankly you didn't need 2020, you could see it at that time. I think way too much capital got into certain spaces where the size of the prize was not as large enough. And, we are seeing obviously some challenges now. So right now, if I think about, I think early stage is pretty healthy. Because early stage, there's a lot of dry powder, as all of us know. I think valuations is not a concern. I think the kind of founders that are starting now are a lot more mission-focused founders, not just, kind of riding a wave. I think growth and late is quite tough right now. So I think there will be, reasonable level of correction that would happen, and founders who are smart will figure out kind of doing a recap, etc. Till the time they control their own destiny versus kind of kicking the can down the road and waiting. In terms of silver linings, I think I find there is a lot more focus both for the investor community as well as the founders around, kind of building businesses that can be sustainable. I keep joking, there was a time where ROI was becoming more return on imagination versus return on investment. So I think we are back to the basics where ROI is return on investment. Folks are thinking about, there's a viable path to go public. A lot more people are coming into the, kind of venture ecosystem for the right reasons. So I think those would be the silver linings. I think while there will be a lot more pain, I think in the long run, this whole kind of catharsis would actually be good for the ecosystem.
That's very interesting. If I may just ask you again, you mentioned something about founders. Are you seeing founders behave differently, or are you seeing funds looking at founders in a different way in terms of how they see the building up of their companies? And this question probably I'll pass on to, out of turn, to all the panelists as well.
So, let me kick it off. I think founders clearly, See, there's some founders who were not impacted by, the boom's time. So they were kind of heads down, they were trying to build something. But I mean, to be honest, I mean, people do look to kind of, adjust the business model and the growth aspirations based on what investors are looking at. So today, I mean, if you look at it, I think there are a lot of founders who are absolutely clear that they don't want to raise way too much capital. There are a lot of founders who are very clear that, we are building for the long term. This is not about just optimizing for the next fundraise. So overall, I'm also seeing that the folks who are coming in now, real early stage, and maybe you would be seeing, I think these founders really, understand that there's no instant gratification that's going to happen. This is a bit, get in the trenches and build something for the long term. So, I mean, overall, I think the quality of founders is a lot better. And when I say better, meaning even in the past, there are a bunch of smart guys at, 130, 140 IQ. But when you realize the system was such where, you could actually, just go 120 miles an hour, raise 2, 3 rounds, I think a lot of people do get tempted by that. But today you are seeing founders who are a lot more mission focused.
Oh, thanks, appreciate that. Anup, to you, a follow-on question, I mean, the same question. Are you seeing founders differently? Are founders behaving differently? And also, what are the segments that still excite you? I mean, you are still busy. It's not as if you're not investing, you have dry powder, but what are the sectors that you think are still really, really exciting for people? Two separate questions, but over to you.
Yeah, I can specifically talk about consumer tech as well in this, right, and also generalize it for the larger segment. I think founder DNA is something that is not necessarily going to change irrespective of, with what kind of a cycle it is, right? The DNA is to build a sustainable long-term business, right, and, ensure value creation for all stakeholders. If you as an investor have assessed that quality in whichever at the right time of investing, I think that DNA is something which will span out during multiple cycles, and you will see those signs of adoption happening, right, of pressing the accelerator when needed, sort of pausing and pulling back a little bit and throwing caution in the wind. All of those are signs of a good founder who's able to zoom in and zoom out, basis the larger environment that they play in, right? But in terms of the overall deal quality as such, right, let me just sort of talk to that at least for the last 6 to 12 months. I think at least in consumer, I can definitely say that the deal quality is something that we have not necessarily seen significantly increase in the last 6 to 12 months, right? I think what we have seen, especially in this space, is D2C and emerging brands as a big lever where everyone wants to create the next, say, a Mama Earth or a boat, and just coming up with few product level innovations to try and bring their own emerging brand to the market. I think that sort of a copycat playbook without definite moats around what their business model is, I don't think is sustainable, and I don't think that excites us as a fund. Overall, I think there are pockets where either by design in terms of the larger, structural changes which are happening, be it, say, the fintech regulation changes which have happened, be it the onset of, say, a new digital platform like ONDC, there's significant innovations which the founders are sort of building on top of some of these public goods, right? So that has something which we are very excited about, and we continue to be bullish on the fact that we will find good technology entrepreneurs building on top of these. In the short term, I think this is going to be, at least from our view, B2B and SaaS are the immediate ones where we see a lot more innovations, a lot more activity happening around. While overall in a 5 to 10 year span, we're extremely bullish on all the sectors. We remain committed to building out and identifying some of the entrepreneurs and supporting them across sectors.
Yeah, that's very useful. Thanks, Anup. Vitali, of course, you've been with Bearings for a long time, and you've seen many such cycles go up and down, many different ways promoter behave during these cycles. Tell us a bit about the promoter's mindset. I mean, how do they find the balance between growth and profitability? Is that a relevant question for companies which are in the various stages of their growth? And what's been your kind of observation on that along the last 15, 16 years you've been doing this?
Look, logically speaking, there should never be a trade-off between profitability and growth, right? You need both growth and profitability. Both are important, both are imperative for a business to survive, to thrive, and ultimately create value for all stakeholders. But as long as a company is generating decent contribution margin, right, you can always take a call on when to dial up or down on growth, depending on what stage of the business you are in, what the economic cycle looks like. So you also need to understand if a company is making losses or burning cash, right? Where is that burn going? If the burn is going to, the company wants to expand its geographical footprint, which means, you need to, a lot of costs, a lot of fixed costs are upfronted, right?
Correct.
It's absolutely okay. If a company is investing in R&D to create new streams of revenue for future growth, which is leading to losses, that's absolutely fine. Correct. Right? But we also need to appreciate the fact that unlike in Western markets, where the path to profitability for company has been much shorter, because the spending capacity is much higher there. In India, the spending capacity is the limiting factor, right? We are a very price-sensitive market. We are a price-elastic market. So for Indian companies, if you're burning cash for discovery, it's okay. But if you're burning cash to solve for this spending capability problem, right, where you're just discounting to acquire a customer, right, that's not very prudent. And ultimately, look, I mean, if a business cannot generate profits, then, why do that business, right? I mean, growth, just for the sake of growth at all costs, growth without profits, only means that you're creating losses faster. So we are of the belief that, ultimately, you need to start focusing on cash flows, and I won't even stop at profits, right? I mean, profits are imaginary. Cash is king, right? Cash is real. So it's very important for us to kind of, help promoters and founders, realize the importance of generating cash flows from a long-term sustainability perspective. And, in an ecosystem where money has been easy, a lot of bad habits get inculcated, right? When your org structure, when your systems, processes, when your incentives, when your values are all oriented for growth, suddenly asking companies to switch gears and pivot towards focusing on cash flows is very difficult, right? It really needs an overhaul of your entire ethos and culture, which is, I mean, not impossible, but very difficult to achieve. So I don't see, too many companies actually successfully crossing that hurdle, but the ones who do, right, I think they'll really emerge as winners, and a lot of times it's in down cycles that you see market leaders emerge. So I think this is actually a good opportunity for founders to reorient their businesses.
So let me then also ask you that question around founders and how you look at the founders today versus, let's say, 2 years ago, etc. The reason I ask is that a lot of the founders in startups in India are very young folks, right? They come in without much business experience in the past, and we've seen it very often that they get extremely influenced by what the VCs or the funds are telling them at that point in time as to how they should run their business. So for instance, if you're having this discussion in 2021, growth would have been the flavor of the season, right? Now we are saying, hey, it's a not so great market, so we're talking about profitability. We know in reality you talk about both always, but I'm saying a lot of young founders take either one or the other away. So how does that work out, as you see it today versus, let's say, in the past? What are founders thinking of when they set up companies? What are the ones that you find more exciting? Are people changing at all? Are they still saying, hey, I'll just ride out the next 6 months and go back into this loss-led growth? What are some of the observations you have there?
So, I think the biggest change that I've seen, and I would say over the last 16 years since I've been doing this is, I think 16 years ago, the quality of good entrepreneurs, the quality of good founders that, we would see was very limited. A lot of times these were family businesses where, basically the next gen, the old promoter would want him to settle the next gen, and therefore, he wants to start a business, and, you get a private equity opportunity there. So the quality of entrepreneurs wasn't that great. But if I look at what's happened in the last, 7, 8 years, because cost of capital has been low, that has really spurred innovation. And innovation is a very expensive hobby. So, you have to give credit to the fact that because money has been available so freely and cheaply, it has led to a lot of genuine innovation. And the kind of companies and entrepreneurs that we see today, 16 years ago, if we would invest in maybe 1 out of every 20 companies that we saw, today, at least we want to at least there are 10 guys we want to consider giving money to, right? And that's a big, big delta improvement. So the quality of promoters has definitely gone up. Yes, the maturity level may not be there because a lot of these are, like you said, young entrepreneurs who've never seen cycles before.
Yeah.
But I think that's where, our role comes in, having been around for 26 years, I think, we are able to guide them better. You're absolutely right. Again, a lot of times we saw, especially in periods of euphoria, boardroom discussions often used to be around next round valuation, rather than, how are you creating a valuable franchise? How are you going to be more relevant to your customer? How are you increasing your differentiation? And, how are you going to be disruptive? But I think now, again, because of funding crunch, I think that those conversations have now veered to what's really important for the business and not, how do you just grow at any cost and get that next round valuation.
Fair. Well, thanks for that. Paulo, shifting gears a bit, you're just starting out on your journey as a fund, and you're starting off with this environment. What are the filters you are using to look at the funnel that you have and identifying the right companies? What criteria are you using for those companies' characteristics or the founders' characteristics, which work very well, or which you're saying, hey, this is a no-no for me?
So specifically in an early stage fund case, most of the green flags are the founder itself. So we see a lot of adaptability. Like for example, we know a lot of founders who came with a different execution strategy about 6 months ago, but they have adapted themselves to be better suited for the environment now. And since you said you're a glass half full kind of guy, so are we. So that is really a great enabler for us to overlook certain. Second, we are a very India-focused fund. We want our founders to cater to the entire ecosystem. Like if there are multiple facets to an ecosystem, let's say they're working in a sector such as space tech and defense, and let's say, for example, they're a drone startup, and if they're addressing the entire drone ecosystem, like one of our portfolios addressing the capital raise, the training, the selling. So that's also a good enabler for us. Like thirdly, we want a mass market approach. We look at corporate governance, we look at a mass market approach, we look at how the startup can expand to tier 2, tier 3, and tier 4 cities. What's its approach? If it's in B2B space, how is it conserving capital? How it's moving ahead? What are the CAGs? So these are normal factors, but governance, factor, founders, these are our key differentiator metrics.
I appreciate. Thanks for that, Paulo. Question to you as well. What are the things in a founder that you look for specifically more than the company character itself?
Rather than the common answers, I think adaptability is one, because it's a constantly evolving space. This is what I've learned in the last 2 or 3 years of working in the industry, and you all would definitely have more experience, but it's a constantly evolving phase. So as long as the founder is able to adapt to the ever-changing conditions, that's a huge plus for us. Second, I generally think that this time is seeing a lot of good founders. There are brilliant founders who are coming up. There are brilliant founders who are coming up with great execution strategies. We definitely think as long as the implementation roadmap and the execution is good, they would do really well. So, primarily.
That's right. I think we used to say in our times when we used to graduate from our colleges and go for jobs, I think the best jobs used to be in consulting, banking. I think the best jobs now are in the startup world. So I guess the quality of people, the best talent is heading there right out of college now, right? So that's probably reflected. Ashish, let me come back to you. As a venture debt investor, typically you have a lesser risk profile than an equity investor. But sitting here and now, the VC investors, the VC funds are also sitting on quote unquote dry powder. So they are, they almost seem to have in the minds of a lot of founders out there, and even more, risk-averse profile right now than you have. What's your thoughts? How are you seeing that evolve? Why are people just sitting on money and not investing? When do you see that change, rather, more importantly? Is that 3 months down the line, 6 months down the line, a year down the line?
I think, see, I mean, there are a host of reasons. So, I mean, I'm going to just quickly talk about a few. I mean, one is obviously, over the last 14, 15 months as things slowed down, I think you see a lot of collateral damage and, generally we had a phase where, things were going 120 miles an hour, deals were happening. Now everybody is overly skeptical. And, I always say things are never as good as they're meant out to be. They're never as bad as they're meant out to be. Kind of truth lies somewhere in the middle. So right now the pendulum has shifted too much to being on the pessimistic side. So I think with dry powder, one is clearly, see, it is not only the startups who raised a lot of money. I mean, the reality is when this whole boom period was happening, everybody's fund size got upscaled. So there is a lot more capital sitting here, and I'm talking about dedicated capital, which is focused on India, not some hedge fund which, can go public, private, etc., right? So one, people are being a little more skeptical. They want to kick the tires a little more. The second is, I mean, we were talking a bit, which a lot of people may not understand, is I think in this environment, GPs are not very, very, they don't want to go to their LPs with too many capital calls. That, kind of starts other discussions on the portfolio. The third is, I mean, I keep talking where, especially in growth and late, some of the larger funds, for them the issue is, I mean, they are actually wanting to put money to work, but as somebody told me, like, I mean, what we like, we don't like the valuation, and where we like the valuation, we don't like the company. And I think there is the realization that certain good companies that they are tracking, whether within their portfolio or outside, they believe that eventually they will get better entry prices because, some of these companies are, I mean, they might have been mispriced, but they're fundamentally strong businesses. Early stage, frankly, I keep hearing anecdotally, some folks are saying, well, the deal flow, the quality of deals is not that good. So I've been hearing, and to some extent, as the ecosystem starts becoming a lot more deep, all the low-hanging fruits are gone. So, if somebody comes, I mean, you are really looking for something very, very, sharply differentiated versus, a few kind of, basic improvements. So I think people don't realize how much pressure funds have to put money to work. Because a lot of the founders don't realize that the only job the VC has is to deploy. So by sitting and just collecting fees from the LP, that really is not a good feeling. So I think eventually as we kind of roll forward 6 to 9 months, in my mind, the pressure is building up. So, for good founders, good business models, I think you will start seeing a lot more deal flow. And I'm talking early stage. I mean, growth and late is a different story altogether. And I mean, the other thing I'm also seeing is that I think a lot of the VCs in the past, all of us included, I think you get into the trap of, well, this is the kind of company that, tomorrow somebody will fund, right? So you probably are not asking as hard questions saying, okay, if you close your eyes and kind of look forward 5, 7, 8, 10 years, is this a company that can, build a model which can go public? Because you are in a different mode, Tiger will come, SoftBank will come, right? So I think people are taking a lot more time thinking through, I mean, is this capital good enough for them to compete? Is this a large enough market? Are these the right people who would, continue to stay in the trenches? And but eventually I feel in early stage, you will see a lot more, deal activity as we get over the next 4, 6 months.
Makes sense. I know one of your colleagues in another panel earlier was talking about exits. And I think Ashish also mentioned, a lot of, I guess, founders and people who are not in this ecosystem directly miss the fact that whenever a fund is looking to invest, they're actually in their heads looking at the exit while they're investing and not as a afterthought. So I mean, that's what you do instinctively whenever you look at an investment opportunity, right? You're looking, that's when you realize your cycle and returns, etc. So while it may be a repeat in the exit terms, what do companies need to do today? It's a tough environment, public markets are bad, valuation are looking good. Some companies may not be able to get as much capital or no capital for growth, even there's the opportunity sector. So all those, issues are there and they're not going away today. But what do companies need to do or you need to do in terms of managing a portfolio of companies or whatever, inputs you can provide to, hasten exits? It's a very important thing from a next fundraising point of view as a country or as a, as an ecosystem for us to be closing those cycles. What are some of your thoughts on how that's playing out?
So, I think India has an exit, exit track record. India's own exit track records have not necessarily been as deep as many of the developed markets.
Right.
That's very clear. I think global funds who have sort of deployed capital in at least two of the cycles have sort of not had the best of outcomes. But let's also understand that we are where we are almost 2-3 decades, probably even more than what US was, sometime back in terms of pure depth of both public market participation and all of those parameters, right? So I think we have a journey to adopt. Yes, we have been fast tracking that journey through our own digital infrastructures that we have sort of built out for expanding that participation. But I think that journey is still going to happen. So to just be event driven or milestone driven to saying that all my exits are going to be from public markets, I don't think is the right approach at all. I don't think that is a measure of the exit opportunity that exists today for venture as a fund.
Right.
Venture funds today in the country. I can talk about early stage. I'm sure, Mitali will have things to talk about on the private equity side. So we as a fund today are not at all dependent on an IPO to generate liquidity for our LPs, right? Yes, to capture the upside and the last bit of the alpha that we may have to get out from the portfolio of the initial investments, yes, we may still be looking forward to an IPO. But otherwise, I think there are enough and more opportunities for secondary funds to participate. There is a potential of large M&As happening in the country. Yes. I think over the course of the last 5 years, we have seen Indian corporates itself sort of build their conviction on investing into technology in India. Yep. And they are sitting on significantly large treasury dry powder themselves to sort of look at the Indian markets to tap into from an M&A perspective. So, and I think my colleague would have alluded to this, we are almost building this out as a 18-month look ahead in terms of saying which assets, what levels of maturity, what strategy do we adopt to exit and provide liquidity back to our investors. Coming back to founders, I think that question is slightly different because it's the other side of the table. Yeah. I think for them, they see a fund house for an average holding period of 7 to 8 years, at least on the venture side, and about probably 4 to 5 years on the private equity side. But there are fund houses like us today who invested in Lenskart back, I think around 14, 15 years back, right? The relationship with Lenskart founding team has not been a one fund relationship. Right. It's been across 6 funds for us now, right? So we continue to back the founder in the subsequent iterations of what we believe are different inflection points of the business. And I think that gives them comfort to help facilitate an exit for the existing shareholders as well, right? And they see us as long-term partners and not only as one-time fund partners who are coming to deploy and take out money. I don't think that's the way the good founders are looking at good funds today.
Oh, appreciate that. Thanks for that. Mitali, wanted to pose this to you. Somebody was telling me, a couple of years back that the whole early stage investing, ecosystem is self-correcting in the sense that huge bubbles may not form because they tend to have companies which morph, which adapt, which don't survive, etc. So it kind of self-corrects. But in India, we've seen that there's this almost expectation that, rightly or wrongly, that companies will just continue secularly going up in performance and valuation. So any corrections in that journey, whether it's in your financial performance or your operating metrics or indeed valuations, down rounds or such, are frowned upon or not good discussions to have, or they're looked down upon, right? Recently in the news, I mean, isn't it a natural part of this ecosystem, and why do we kind of think of it negatively? Doesn't that hurt the prospects of the entire industry? If something is not working, hey, you know what, you started off as a VC venture capital fund to say, hey, all of my bets will not work out. So why is it that there's a almost stigma attached to not working out, and take corrective actions quickly enough and move on? Why is it that we still kind of try to, so to say, flog a dead horse, more than its life cycle?
Right, Nitish. There is down rounds do carry a negative connotation, and, unfortunately, there's a lot of stigma attached to the company and the founder when they do a down round. But if you look at the West, right, which is a more mature market, which has seen more cycles, there have been a lot of successful companies which have raised down rounds and then, overcome those hurdles. And a classic case in point is Facebook, right? I mean, Facebook, I think in 2007 had raised money at $15 billion. Then they saw a dip in their valuation. In 2009, they had to raise money at $10 billion. And then finally, they went IPO at over $100 billion. And, the rest is history. So you need to look at some of these examples as well before, attaching a very negative connotation to down rounds. And look, sometimes, just biting the bullet and doing a down round may be the most sensible thing to do, right? And there is no reason why, promoters should hesitate in kind of, resetting the valuations to something which is more sustainable. And it's imperative that promoters and, investors as well accept and deal with reality. And often that reality can be that, this down round is a way of market signaling that whatever the company has been doing, it's clearly not, creating any sort of additional value for stakeholders. Or whether the business plan and, the disruptive presumption that was there no longer exists. So it is also a chance for promoters and founders to, kind of take a objective look at their business, and try to course correct, focus more on how can I be more relevant to my customers, focus on tightening their belt, focus on, changing their business model to, become, stay relevant in this industry. And those changes, like we discussed earlier, right? They're easier said than done. But companies who do, swallow that bitter pill, I think, will emerge as winners. And look, the fact is, down rounds are no one's obvious, preferred starting point, right?
Yeah.
For founders, for also anyone who owns common equity, it's a huge impact on their shares, and you'll see a massive dilution. And even for funds, investors who've come in at higher valuation, yes, you are protected because of anti-dilution rights, but you're still impacted, right? And there's often a lot of negative press associated with these situations. There is always a drag on momentum of the businesses which do down rounds. Ability to attract new talent becomes difficult. And even, your existing employees, once their stock options are out of money, there's always the risk of attrition. There's always a risk that, the morale of the team kind of comes down. But having said that, I don't think just because a company does a down round, it doesn't have to necessarily mean that the company has no future prospects or that, it's an utter failure. And by that same logic, just because a company has raised money at a high valuation doesn't mean it is going to be a success, right? So it is very important that we distinguish between the value of a business and the valuation of a business. Those are two very different things. And as long as the underlying value of the business is not eroded, right? Even if the valuation goes a little up and down, I wouldn't be too worried about it. In fact, as an investor, if I see a down round happening, I would see it as an opportunity to probably, participate at a lower valuation. And like you said rightly, from the entrepreneur's perspective, you should see it as a glass half full. Because even though it is a down round, you're still seeing, infusion of capital into the company, which means, the investor it's a signal that, someone still believes in your business and your business model, right? So I think I think it's a matter of time as you know, our markets become more mature, you know, these things will become more acceptable. And we also forget, right? I mean, I think it's being discussed since today morning session that for the last, you know, since the global financial crisis, you've seen a secular increase in liquidity in the markets. You know, all the central banks globally have been on a printing spree, and we've been in an era of what I call as free money. So when you have free money, right, it doesn't matter, you know, whether the company is generating cash flows today or after 3 years or after 5 years or after 10 years, because the present value of that is the same, right, when your marginal cost of capital is zero. But when that marginal cost of capital starts going up, and which is what has happened in the West, and it's gone up very sharply, right? Over 18 months, it's gone from almost 0% to 5%. And on top of that, you have your equity risk premium. So when, you know, your average cost of capital has almost doubled, it is bound that, you know, a lot of valuations which made sense until 2 years ago, which made perfect commercial and economic sense, don't do so at this point in time. And I think entrepreneurs and investors as well, you know, just need to accept and relook at everything based on this, you know, new reality. So like I said, you know, I think to conclude that as the markets become more mature, as we start seeing more cycles, I think it'll become socially acceptable to do a down round. And it's just human nature, right? I mean, the first guy doing a down round is bound to get rammed in the press. But when, you know, you've had 100 companies, and there will be 100 companies who will have to, you know, go through that pain. No one's going to pay attention to the 101st guy. So I think it's just a matter of evolution of the markets. Yeah.
Interesting. Thanks for that. Pallav, do you see a change? And I know you've done investing in the past as well. So do you see a change in the way investors interact with their portfolio companies post-investment? Are they going to be more active, more you know, involved in the businesses because times are not so tough? Or do you think, you know, it's not going to be significant change? Is that good? Is that bad? What are some of your thoughts there?
So from a perspective, the last 2 to 3 years, definitely the interaction has gone more. They interact more, they work on synergies, they work on cross sharing of ideas, they try to keep them together, they try to address market inequalities. So definitely there's a lot more interaction, and rightly so as well. With the over-evolving concept of CG or corporate governance also, there is a lot more interaction at their end. So one of the key, I'll just share advice that one of our advisors keep sharing with our startups is that even if you do not plan to do an IPO, prepare for one, because that would ensure a certain level of governance, compliance, outlook. So funds are getting more advisors on board, funds are getting more systemic approaches on board in their entire interaction strategy. Funds are also trying to get deep in the trenches with the startups on braving these market inequalities. So definitely a lot more interaction.
That sounds like good interaction, right? That sounds like something that will add value to the overall system. But there's this question always in everybody's mind: how much should a fund interact with a company? Because a fund manager's job is to find the right, right founder and leave them be it, right? So in this environment, that obviously that balance shifts, right? So last year, a lot of people would have been okay with spending less time because everything was going up. But now they're spending more time, and some people would do it right, but some may not do it right? Some people may just interact or whatever. So do you see founders behave differently as well as a reaction to that?
See, I think excessiveness of everything would definitely result. So since we've already invested in the couple of startups and we know that they're capable of running the business, all they need is a little push or a little, let's say a little more ideation cooperation. And that's about it. Most founders are okay with it. Certain founders, if we go overboard, that we will know you have to do this certain manner, you have to do this, then definitely there will be some pushback. But that's also human intelligence to navigate. So,
Anubhav, I did see you nodding ahead in the middle of that. Any thoughts on how much interaction is too much or how much interaction is too little? How do you guys find that balance with your portfolio of founders?
See, I don't think it is a measure of how much or how little. I think it is a measure of what a specific investor is bringing to the table, right? There are some investors who are very clear, they are passive, they play their role, they're fine in taking a back seat, they're probably available on call for specific purposes, right? But if you either have a right to appoint to a board or you have exercised that right to appoint to take a board seat. I think there's a fiduciary set of responsibilities now which is sort of becoming overly emphasized that you need to play, correct? Especially given the current larger environment around governance and other things which is also playing out. But going back to your question, I think it is purely a function of ensuring that the founder leaves that conversation with some value additive. That's how we look at it. If I'm not able to add value into that conversation to the founder and just asking questions, I just don't think, you as an investor is going to be even rated highly by the founder in the community itself. So if I have to go out and win deals over my peers, I better be someone who can bring value to the founders in my conversations on a sort of a repeatable fashion. And if given the kind of background and legacy that some of the larger funds have today of having spent almost close to 2 decades, I think there is a significant amount of learnings that you can bring to the founders that, which are extremely valuable and, appreciated by the founders as well. So just going back to the question, I think there are different types of investors in the ecosystem today, like angels and micro VCs and larger funds who are, probably lead investors. And I think each one will play a different role depending on what kind of fiduciary they have to their investors. But anything to burden the founder, I think that's where you should draw the line and not cross that line. Because you're just taking away significant amount of founder time and bandwidth to do investor management, which is not going to give you guys also an outcome at the end of it.
Good. Mithali, Ashish, any thoughts on that?
Yeah, I think just to supplement what Anup and Pallav has said so far, right? We've typically found that, if you go to founders and tell them, do this, do that, don't do this, don't do that, there's often, always resistance, right? And, it's probably because of this not invented here syndrome. But what we find to be very effective is, you ask the right set of questions, you prod them in the right direction so that they come up with the same set of solutions that you want them to implement, right? Then the chances of those solutions getting implemented is much higher because then they own they've come up with the solution and they own the, solution in that sense. So I think we find that to be a lot more effective, wherein, you get them to come to the right conclusion rather than you telling them what to do.
I'm just going to ask one last set of questions and we can open it up for Q&A for this day, which is, I think another negative buzzword floating around, which is corporate governance. Feel free to jump in any time, but, just thoughts on corporate governance in terms of, we hear a lot of negative news, but what is it that needs to be done to make sure that things don't, unravel the way they certainly do in the Indian context? What should founders do? What are you all looking to do to kind of look around? Is it doable, not doable? What are some of the thoughts? And feel free to jump in, whoever wants to jump in.
Yeah, let me kick it off. So, clearly, way too many governance issues have, come to the fore. Having said that, I would say a vast majority of founders and the CXOs, they are, doing things the right way.
Right.
And these governance issues, it wasn't like, these happened in the last 6 months. Eventually, this is how some companies were being run. And obviously, it was a shared responsibility in a number of cases. I think you were talking about fiduciary responsibilities. I think a lot of the investors, board members, really either didn't ask the hard questions or didn't spend enough time, to think about, instituting the right kind of mechanisms in place. My sense is the only way, so there are 2 or 3 ways which governance will go down. One is essentially, in the past, if you think you can get away with it, I think today, when most people realize that you can't get away with it, not only would this eventually come out, there's no place to hide. I think some of that will be a role that will play. I think the other thing is clearly with the whole investor community, auditors. I mean, even CFOs, professional CFOs today. I mean, they are very nervous. I mean, if they feel like they're not doing so. I think eventually, all the stakeholders are wanting to make sure that these kind of issues don't come up. But eventually, I think it will get down to. I mean, ultimately, the founders are running the show. So, the kind of people that you get, in these companies, I think that to a large extent that determines, what the culture would be. So overall, I think there will be a little bit more. I think there will be more that will come out, in this whole next 6, 9, 12 months. And after that, all the stakeholders, including founders, including investors, auditors, board members, I think they will. I think there will be enough tightness to ensure that this doesn't become a pervasive issue. But again, coming back to what I started with, I think a vast majority of people are doing things the right way. But unfortunately, the things that go bad, I mean, they do get amplified a lot more. So hopefully, we won't hear too many news items on this front in the future.
Mitali, Anup, any thoughts? How are you looking at CG in the current context? Is it different than last year? Are you proactively doing something to solve for it?
Definitely high on the radar, definitely high on, especially in an environment where if you look at how the time allocation also is, right, portfolio management over investing itself, given the current investing environments, I think working a lot more closely with the founders and the startups to put in place systems and process which align. But I think a simple way to look at this is there are roles which much of these stakeholders have to play. The founders, the board members, the auditors, both internal, external. I think if everyone sort of is able to play their role, we are trying to ensure that all of them have the right sets of skill and the tools to ensure the right sets of systems and processes in place. Yeah. So as a fund house, we are ensuring how do we sort of empower our own deal members as well as the startups, founders to bring in place those systems of checks and balances and taking it forward from there.
Fair enough. Any additional thoughts, Mitali? Are you looking at this differently, spending more time, less time?
I would say, look, I mean, it's not really changed much at our end. We've been quite anal when it comes to having a very long, detailed process before we, invest in any company. So a lot of those, I think, issues do come out before we put out money. And at least till so far, I mean, we've never been in a situation where it's been post-investment, so touch wood. But look, at the end of the day, any sort of risk aggregation and capital allocation is fundamentally based on one principle, that the person who's handling the resource, or the resources, and in this case, it's often the promoters, they are a trustee of the shareholders, right? Correct. And correct. They have a fiduciary responsibility that has been assigned to them, for which they obviously get compensated, right? So when you lose sight of that trusteeship, right, and that's when when they put themselves ahead of that relationship, is when you see them, compensating themselves over and above what's fair. You start seeing a lot of related party transactions. You start seeing, a lot of these hygiene issues that correct. Start cropping up. So I think we make sure that, our agreements and, our conversations with the promoters are very watertight when it comes to all of these issues, when it comes to any sort of promoter compensation, when it comes to any sort of related party transactions, capital allocation decisions. We make sure we have veto on all of these so that the chances of things
so
going
to solve
forward.
For it before the investment itself.
Yeah.
Fair enough. Pallav, any thoughts? Otherwise, we can just open it up for Q&A.
I think it's a collective responsibility. When we talk about oversight and corporate governance, as we said, that these issues have been happening for a far long time. And we were discussing right outside that there was a certain amount of leeway, which was okay. But we can't decide how much leeway is that adequate amount of leeway, right? So not purely from the startup front, I think also investors also need to ensure that are there any roadblocks in our strategy that are forcing the startups to commit such oversights, and collectively to address the entire issue around it. So it's a complete stakeholder responsibility, and all of us will have to play a part in ensuring that these newses do not deter any more founders or investors or LPs who want to put money in India or the economic conditions.
That's fair. There's one very unique thing about the startup ecosystem in India. I guess some parts of the world, but more amplified in India is that everything gets noticed and reported and talked about a lot more than many other parts of the economy. And I think there's a lot more noise around everything, which amplifies the ups and the downs far more. So fair enough. Really, thanks so much for all the comments. Can take Q&A. Anybody had questions? Please feel free to pose them.
Yeah, hi, good evening. My name is Dev. I'm an early stage founder. The company's name is Mr. Med. I want to have a quick question. Mitali, you spoke about some of the bad habits that sometimes has now been inherited, but we have the opportunity to sort of solve for those bad habits. Primarily one being discounting, growing, acquiring customers just based on discounts. I wanted to understand what are the other bad habits that you've seen, and primarily when it comes to hiring of talent, are there any sort of norms that you think, obviously like Nitish said, it's become like startups are the place to go to now for any top talent. Is there something that you look at when it comes to hiring? And is that there's this fine line, and what that line would be between a good practice and a bad practice when it comes to hiring of talent and the sometimes obscene salaries that we pay. The second thing that I wanted to ask you was any other bad habits, and you as funds, what are you doing to make sure that these bad habits do not percolate down to early stage founders as well? Because we have to also sort of, it's a trickle down effect.
So look, like Anup said, right, I mean, it's very difficult to change the DNA of promoters. So where we think there are really bad habits which are cast in stone, I think we just prefer to stay away from those situations. But, a lot of times what we've also noticed is companies who've had access to capital from day zero, right? They've never had the need to be frugal. They've never had the need to think about efficient capital allocation. I think in this environment, I think a lot of founders are now forced to think about these things, right? So whether that frugality, if it's not in your DNA, will you be because circumstances are forcing you to go down that route, whether they'll be able to pivot and change themselves and their organization culture to start focusing on these things, I think that's it's a very personal thing, you need to get that feel for the person and the organization and their nimbleness and ability to transform, and what applies to one may not apply to the other. So as long as the promoters are willing and on board, there is no reason why I don't see these changes can't happen. But it's a tough one. It's not easy, changing the ethos of a company. So I missed your second question.
Any other bad habits? And also, if you could speak to and just for all of you, right? When does, obscene salaries make sense, and what's the line to draw while going out and, hiring top talent?
They always make sense if you're the recipient, but I'll leave it to the rest of people to
Yeah, so if I can take that, I hope I'm audible. See, finally, I think talent, especially in the early stage, comes to a startup when the founder is able to sort of paint a vision and provide a role that's exciting enough for a person to come and join him and take that early stage risk, right? So like an investor risk, taking a risk, the talent who's joining you is also taking that kind of a risk, correct? And we have seen all forms of compensation ranges, right? We have seen people who have taken almost, 25% or 20% of their overall market rates and coming and joining. And we have seen guys who have been able to take their pound of flesh and come into probably 30-40% higher salaries as well. So I think prima facie the role is of the founder to sell his vision and attract the right talent to come on board and join him, right? That sort of sets the benchmark of at least the first level below him or her in terms of identifying the right organizational teams and the leaders within your organization to supplement you and what skills that you have on offer. How the person builds out his team as such then becomes a function of access to capital, access to the timing of what kind of talent that you need at different junctures of time. And mind you, I think there are phases where, even CEOs have sort of changed hands, right? The baton has moved from a founder to a professional CEO coming on and taking on charges as early as probably Series D and E stages. And that's very common in the developed markets. I'm sure in the going ahead in the years to come, I'm sure it will be more common in India also. So I don't see that as a bad habit of setting, salary benchmarks. It is a competitive environment. Everyone will fight for talent, but you have your responsibility as a founder to sell a story and a vision and attract the best as well. So it's not only the talent trying to sell their capabilities and skills to you, but you trying to take your product and your platform out to the talent as well, right? So I think it's fair game to identify what the market sort of sets as the price benchmark.
Good evening. Anil Nagpal from Genex 360 India. Thank you, panelists, for a very insightful discussion. I found that particularly helpful to me. On similar lines, I know that we all like to, as investors, align ourselves with the founder, with the promoter, before we get in.
Could you hold the mic closer?
Yeah. Can you hear me? Yeah. In cases post-investment, if you have conflict with the founder or the management team, where there's misalignment, whether it be strategy, business practices, in your investment experience, if you've had such cases, how have you resolved for this, if any? Thank you.
I mean, I'll just jump in here. I mean, those are the most difficult problems to resolve. I'm not talking about the bad habits, the bad things which cause those, but sometimes investor and a company come together with a set of assumptions today and they change a year, 2 years, 3 years down the line. Those are the most difficult problems to resolve because that does mean that your assumptions from many years ago are different to what they are today. So somebody needs to give up something, either financially or otherwise, or in cases of in the minds of some founders, they need to give up the companies themselves much earlier than they want, or they may need to take them public or not take them. So something has changed, and it's different from what they are. So those are not easy problems to solve, and there's no solution to it. I think there's a whole industry of people within funds and advisors who are devoted to solving those problems. Those are really human problems. I think it's no different than while, let's say, a couple going through a divorce. Things are not working out, and there is no textbook or there is no playbook with, let's say, even 100 variables that you could tweak to figure it out. It's a very, very independent situation, and you just have to kind of figure it out at that situation for those set of people who are doing it. And a lot of times they don't resolve. Like I said, it's not just in investing. It's part of life. But sometimes those are the toughest problems to solve for.
And I was just saying, see, it also depends on the kind of misalignment. Yeah. So there are certain things which are table stakes, right? I mean, there, where, I mean, things that from a company standpoint, culture standpoint, a lot of the investors do have certain veto rights, what we call reserve matters. So there, I mean, that's different. But, if it is about the strategy of the business, I think generally more often than not, I think obviously you want to ask the right questions, but eventually, I mean, you have to go with the management team and the founders who are much closer to that problem. And if you have like a total major misalignment, and there are other investors who are aligned with that, I mean, slowly you could have a situation where you basically continue to become a smaller shareholder, you sell. But again, for business strategy related issues, I think eventually if you ask the right questions, but I mean, the founders have to finally, I mean, it's like, you could be Sehwag's coach, but you can't tell him, how to hit, right? He will do what he wants to do. So beyond that, there's only so much you can do.
Got it. Thank you.
Yeah, Anup, have you touched upon Web3 already, in case I missed it a bit, but that was one sector that was, in vogue last year, and I understand you have. Are there pockets within Web3 that are still promising to you and you are looking at actively?
Addressed to me.
Yes.
Yeah, sorry. So we have never done or been big on the crypto side of things as a fund. I think individually we may have, in personal capacities, try to understand that and dabble with it a little bit. But as a fund house, I think as an asset class, we have not necessarily seen how long and sustainable that end of that spectrum would be. So we've never taken bets on that side. But over the course of time, I think there is a clear understanding that the Web3 infra side, which is built around tools, toolkits, infrastructure SaaS, all those elements are something that we are keen to explore and continue to have conversations with. There could be certain pockets or use cases like potentially say gaming and content and few areas where we may be excited about trying to see what next as innovation is happening. But if it is driven through a token economics, we are not very gung-ho on driving our benefits or upside as a fund house on the tokenomics side at all. So if there are value propositions on that side, I think we would be more than willing to sort of look at it. We do not also have a token fund set aside. So we do invest only in fiat, just to clarify. But I think the space will take some more time to evolve. I know it is quite mainstream in many pockets in the developed economies and many other places, but whether, and especially given the last 12 months of stress that the entire crypto side of this Web3 has sort of seen, how venture fundable are some of these playbooks is something which we will wait and watch.
Any other?
Hi, good afternoon. This is Rahul from Prime Securities. Thanks for the panel. If you're faced with a hypothetical situation where a portfolio company of yours is forced to get into a down round by you guys, but they refuse, and the other alternative is the startup goes downhill if they don't accept funding now, what would you do in a situation where the founders are not willing for a down round? Will you let the startup sink, or will you give them the valuation they want? Or let me know what
I'm not able to hear you very well. Could you repeat that?
I'll repeat. Let's say you're faced with a situation where a startup needs capital, but they are not willing to accept a down round, right? But you are offering them a down round because of your cost of capital or because of the market conditions, but the startup does not accept. And the alternative to that is the startup goes downhill if they don't get funding. So what would you do when you're faced with a situation like this where a startup is not going to take the down round? Your portfolio startup is not accepting the down round.
So you're saying if a startup is being offered new money at a down round and they're not saying yes to it?
Yes, exactly.
And you're assuming that this is a portfolio company of one of the funds?
Yes,
Okay.
definitely.
See, there may be, see, one, clearly there is, it doesn't mean that everybody has to do a down round. There are companies that have been able to kind of reprofile the business, the burn, the focus, and where, they can kind of ride it out, maybe do a small internal round and kind of raise money from a position of strength down the line. But coming back to your question, if you are forced to do a down round, I mean, whether the founder likes or the board likes, I mean, you have no choice. I mean, cash is, it's not like a hazy subject. So every month, if you're looking at your bank account and you know your burn, and eventually money, when you have runway of less than, 6 months, I mean, time is your enemy. And if the down round, either the founder is able to find an investor, who is willing to do a flat round or convince their existing investors to do a convertible round and kick the can down the road. Otherwise, I mean, there's no choice, right? If the money is out of the, nobody is going to just close the company for an ego saying, I will not do a down round. I mean, there are, hundreds of employees involved, etc. So, I mean, to the extent people can avoid it, they don't want to do a down round. Having said that, I have seen, founders who are very pragmatic. They don't leave it too late. When you have, let's say, 6, 7, 8 months of runway left, and you realize that you were overvalued, you rather kind of structure the down round at that time. I mean, once you get into 3, 4, 5 month period, I mean, you don't control your own destiny. So I think eventually it's nobody wants to do it, but I mean, if you run out of cash, I mean, there's no choice, right?
Nitish, where does the M&A part come into this piece? If the existing investors are not on board and the founder doesn't want to get down round, do you guys come in and suggest an M&A, and are you seeing that market evolve in recent times? With 6 months as a runway, is that a good time, or should they look at it before then even that?
See, all the, lot of, depending on the shareholding and the rights, I think most of VC companies, apart from a few, I mean, if all the investors, have a conclusion that the company independently would not be able to raise capital, or I think there is a much more, I mean, clearly you can force that, but I think in most companies, typically this is more organic. So if the founder has a different vision, they want to raise, kind of chart an independent path, obviously every investor would like to give them the time to work it out. I mean, if things are not working out, there have been cases where investors, have the right and they have been able to convince or, kind of take a company to a buyout type scenario. So, but generally, I think nobody wants to force it. Very rarely does it happen. Where I think, investors would say, well, we want to sell the company. In all likelihood, the founder took some time. There was a plan that was agreed, 12, 15 months. Maybe that, things didn't work out. And so that's how I have seen. But
no, I agree to that. I mean, also, I think in the Indian context, a little bit more than in the West. I think, for example, we always say, right, drag rights almost never enforceable in India. Even if the time has come where it would be right for an investor to drag the founders to an exit, right? They're almost never enforced. I think it's as much cultural and the social aspects that come into the picture. Those are softer factors. So where this discussion started of some founders not accepting, let's say, reality of saying, hey, this is what it is. I don't think the logic is ever being questioned by either party. I think it's an unequal, I think stake in that. A fund will have only a small portion of the money deployed in a particular opportunity, whereas the entrepreneur has got 100% of their life devoted to it, right? So they always tend to hold out for a little bit longer. Of course, somebody needs to counsel them on what is doable and not doable, and that's never easy. That's a great thing. And that's what leads to some of these, let's say, quote unquote disputes or differences of opinion. A lot of people like us, I think an M&A is an outcome of a lot of counseling work that we end up actually doing. In fact, even at the funds, a lot of portfolio company management is less about the technicals of what you're doing and more about, about discussions with people around what is good, what is not good, what makes sense, what doesn't make sense. It's never about getting the technicals right. You'll always get somebody to tell you, hey, this is what looks right, but the decisions that you have to take are always a gray space. And there's always a risk associated with it, there's always a return associated with it, there's always a personal stake associated with it. In the case of an M&A thing that you were asking, like I said, the best example is that the drag rights are almost never enforceable in India. Funds do not, there are very few examples of successful drags where an unwilling promoter has been dragged by a fund extremely successfully with no additional negative outcomes post that event as well, because that doesn't happen. So the best bet you have is to try and convince that person. I think in the Indian context, a lot of advisory firms like us and others, we see a lot of times chartered accountants of those companies, lawyers, etc., also play a very, very influential role. Basically, it's somebody at that point in time who understands what's happening and is trusted by that person, and a lot of effort goes into that. But like I said, nobody can predict, nobody can come up with a playbook that leads to a good outcome out of that. It'll either happen or not happen, you can't predict. You just kind of jump in the pool and figure it out.
Any further questions? So otherwise we'll wrap it up.
Thank you for such an insightful and interactive session. I'd like to invite the panelists forward for our group picture. Yeah. With that, we have come to an end to the formal proceedings for the day. Thank you once again to all our sponsors, speakers, and the very engaged audience.